It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today we're taking a look at the energy sector in the face of economic and political uncertainty. I'm here with Hennessy Energy Transition Fund Portfolio Manager Ben Cook. Ben, it's good to see you.
Hey, good to see
Thanks
you too,
for being
Julie.
here.
Thanks for having me.
So let's get to the stock you like. That is ExxonMobil here.
Yeah.
One of the energy majors, of course, that's been moving somewhat into the energy transition in the past few years. The stock's up about 7% over the past year. So that's the chart that we're showing there. And as I mentioned, it's integrated. So it's produces oil, refines oil, and makes it into other stuff.
That's exactly right.
And then it also has a bit of a renewable business.
Yeah, that's right. You know, we like the integrated business model because it affords flexibility to generate consistent financial results through the cycle, the ups and downs.
Gotcha, because it has that sort of diversification if one part of the business isn't doing as well.
Exactly. If commodity prices are high, they're making money in the upstream business. If commodity prices are low, their feedstock, they may be making money in the refining business. So it tends to balance out the ups and downs in the business cycle.
And so, and when you look at the sort of history of how they've managed the business cycle, to your point,
right,
you think they've done that pretty successfully?
Yeah, we think they have, and more recently through acquisitions and through the drill bit, they've done a great job at growing their upstream business. Just this earlier this year, they closed the Pioneer Natural Resources acquisition, a very sizable upstream acquisition in the Permian Basin. But they've also, they've made tremendous success in discovering oil resource in Guyana, and we're starting to see the fruits of those discoveries now with significant production volume growth.
And you think they'll have a favorable outcome in Guyana because, of course, there is now a quest by Chevron to buy Hess. Exxon has been sort of, if not protesting that acquisition, at least sort of exercising its ability to protest that acquisition.
Yeah, that's an ongoing issue for both companies, but we don't believe that's an impediment to getting the deal done, the Chevron-Hess deal, and we think it's ultimately an area for future growth for Exxon as well.
And then also, when you're talking about any of the oil majors, you talk about cash return. That's a big part of the story here. And Exxon's been pretty steadily doing that.
They are obviously a household name, but they are probably best in the business at returning capital to shareholders. And it's a function of capital discipline. It's being measured in terms of spending, but with the cash that's being generated, they first pay down debt and then ultimately return cash in the form of dividends and share repurchases. And they're doing that to a great extent today. So we really like the aspect of the cash return profile for Exxon.
Now, whenever we talk about any of these stocks that our guests like, you have to talk about what could be a potential risk here.
Sure.
And for there, you're looking at the sort of more macro environment as a potential risk.
Yeah, we are. Exxon's fortunes are tied to the level of commodity prices, both crude oil and natural gas. And, were we to see a weakening in the global economy and a weakness in commodity prices, it would certainly have an impact on their upstream and even their downstream results. So any kind of weakness to the global economy would certainly have an impact on the company's equity performance.
Do you see that happening at all in the coming year?
No, we've got an accommodative Fed. We have global monetary authorities that are acting almost in concert to ensure that their economies are stable and growing. And so it's not likely that we see weakness in crude oil prices in the near future.
All right, so that's the stock you like. You hold it in your portfolio. Let's talk about the stock you don't like as much, and that is First Solar. The stock's actually done quite well over the past year. It's up about 19% here, but this is one that maybe is going to go either way depending on how the election goes.
Yeah, potentially it could. We have the ability in managing the Hennessy Energy Transition Fund, the ability to invest in both renewables as well as traditional hydrocarbons, and we've chosen to de-emphasize the exposure to renewables. And this is one of the primary reasons. A company like First Solar obviously benefits from a domestic supply chain, but there's protective policy measures in place for tariffs that help them generate revenues on their solar panels. They benefit from investment tax credits. These are all things that depend heavily on policy, and depending on the outcome of the election, those supportive measures could potentially evaporate on them. So it's a risk we prefer not to take.
Gotcha. And then if we were looking at other, the sort of bigger picture here, the energy transition does seem to be sort of losing some steam.
Yeah, in our opinion, there is an uneven pace of transition. A lot of it is the uncertainty of policy across geographies, but it's also issues associated with reliability. Solar panels obviously can only generate that power when the sun is shining, and so there needs to be some sort of backstop for power generation, either a hydrocarbon-based solution or a battery, and right now battery scale technology is just not there. And the other issue really is cost advantages. And if you add the cost of batteries or some other solution on top of solar, obviously solar power becomes less attractive from an economic standpoint.
Right. Although to be fair, the cost of panels has come way down.
It has.
In comparison to where it was just a few years ago.
Down dramatically.
But I guess you have to think about that total cost that you're referring to, which is a good point.
Indeed.
Let's also talk about interest rates. This has been sort of an obstacle for the renewable industry. But, rates maybe are going to come down at some point in the future.
More than likely they will. There is probably a non-zero chance that interest rates stay where they are right now or potentially go higher. But it is a risk to the company if they do. Project development costs make up a significant component of the return profile for investors, and if interest rates go higher, that cost of capital eats into the returns of the project developers. We've seen it happen with wind. We think it potentially could happen with solar. Another reason for us to sit on the sidelines with First Solar.
Gotcha. So just like we talked about the risk to the upside for Exxon, let's talk about the risk to the downside here. We kind of referred to it, that interest rates start to come down, or that the energy transition starts to pick back up. I assume also if you don't have a change in administration, maybe that would be more positive.
Correct. The status quo in the executive branch of Biden election victory would certainly extend, I think, the favorable tax credits that the company enjoys and the tariff policy, the protective tariff policy that we see. On the other hand, if we see a Trump victory, many of those supportive measures could go away and would obviously be a detrimental trend for First Solar. Again, those are risks that we prefer not to take with our portfolio.
Gotcha. Want something a little more reliable in your view, like Exxon. Got it. All right. Thanks so much, Ben. Appreciate it. And you don't have a position in First Solar, we should mention to our viewers. All right. Thanks for being here. Appreciate it. And thanks you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes at 3:30 p.m. Eastern.